Welcome everyone to the Kindle Report. Well, it's Sunday night. We're starting another week. Last week flew by. It was a crazy week. We saw the S&P up 2.7%, NASDAQ up 3.1%, and the Russell was down 0.5%. That spread continues to unwind that I talked about several weeks ago that I thought it topped out. We've definitely seen a change in that rotation, and the large cap tech stocks are taking back over again. Came very close last week to printing a new high. But as we look at some of the technicals, which I'll go through in great detail here in a minute, we're not seeing any acceleration on the weekly or the daily charts on any of the indices, especially on the S&P and the NASDAQ. But they are in trend mode. It's somewhat disappointing that after last week's strength that we didn't see some acceleration. As I mentioned, we're still in a trend mode. I'll go through all those details here in just a few minutes. As we look to this week, we have a lot coming out. Monday's basically just the Treasury budget. No one really cares about that. On Tuesday, we have CPI. This is going to be a big number. It's expected to show a 0.6 number on the primary and on the core, a 0.3. My expectations are we'll probably come in maybe a little hotter than expected. So we're going to be watching the 10-year, how it responds to any type of increase on the CPI. On Wednesday, we've got the Beige Book and mortgage apps and a whole bunch of other stuff. Almost everything that comes out on Wednesday is immaterial. It's not like they have much of an impact at all. Thursday is a huge day. We've got the typical claims expected around 705. The continuing claims last week came in at 3.7. I'm still looking at a 3.2 number. If it gets below that, then I think it's material. Other than that, I don't think that the continuing claims number means really much of anything. On Thursday, we're also getting retail sales. It's expected to be up 6%. Now, this number could surprise either way with this kind of expectation. So this could be an interesting number as it comes out the same time as a lot of other numbers. Industrial production expected to show a 3.2% gain. Housing index, there's a lot of stuff coming out. Capacity of utilization expected to show a 0.75 number, which is robust considering where things were not that long ago. But on Friday, we have housing starts. We also have the University of Michigan consumer confidence numbers coming out on Friday. So there's a lot to digest. The end of this week is just likely to be very volatile, a lot of data to look at. And I think markets are going to be really focused in first off when that CPI number comes out, and on Thursday, all of these numbers are going to be material. So there's going to be a lot to look at on Thursday and for markets to digest. So my expectation all the way coming into next Friday is a lot of volatility. We are seeing the database on a short-term level continue to get some traction. We triggered that 42% level, so I'll go through those details here in a minute. In closing, we did see Chairman Powell on 60 Minutes on Sunday night really didn't say anything that was surprising. The one thing he said I thought was interesting was, and the news lines picked up just on the headline, is that the economy is at an inflection point, and he actually was referencing to the vaccines and states maybe opening too early and that there might be another COVID surge. He's keeping the government line on COVID. I do think it's at an inflection point, and that inflection point is where we're going to see further acceleration in the opening. It's too late to turn back now. The economy is going to continue to open up. There's going to be a lot more demand. There's going to be more pressures on a lot of prices, and the Fed continues to keep this very dovish stance. So the inflation numbers are likely to increase quite a bit, and I think they want it that way. Powell has certainly indicated that in past statements from the Fed, as well as his conferences that he's done over the months. So they said they want things to run a little hot, and they're willing to let it run hot for a while. Some of the things that I've talked about in the past, and it strains on all of the shipping channels and everything being backlogged, this is likely to keep inflation going up. Even though the Fed sort of claims there is no inflation, we all know that and we see it. It's real in the economy, and market participants are going to be measuring that. And so the 10-year will be very important. I'll cover that briefly tonight just to give some context of what I expect. So let's go ahead and take a look at the charts and see how this week is set up. As we begin with the WaveTech Database overview, the weekly models ran on Friday night. Not a lot of activity. We're at 76% bullish. We're currently 11 of the 12 sectors are long. There's 92 of the industry groups long and 12,476 symbols long. As we look at the activity on the models, we see there were about 310 buy signals, about 310 sell signals. It's totally neutral on the weekly models. When we look at the daily models, we saw a little bit more of a rotation. We're now at 42.5%, just above that magical 42% level. So this suggests that we're going to see a continuation of the traction that's coming on in the database and that the markets will continue to climb higher in the pattern. I expect to see this move to a minimum of 62 to 68 and possibly into the 80 percentile range if we start to get some acceleration out of these markets. The first market that I'll review tonight is the 10-year. The 10-year was up 2.08% on Friday. We did see it move back to the 1.66 level. This pattern that's setting up is what I talk a lot about, is a dragon head, and the dragon head suggests there's a continuation to the upside. PPMs are very positive, with PPM 1 at a plus 3.93, a plus 3.08, and a plus 2.6. And these are the weekly charts we're looking at here. And this is a very robust trend that's unfolding. The 10-week moving average will be the primary demand line. In this case, it will actually be, this will be the primary supply line. This is where, if we get to that level, which is 1.51, we would see, most likely we would see the rates tick back up from that level. Otherwise, there'd be selling in the bonds. The PPMs are fading a little bit, but at this level, they're about to go into what I call trend maintenance mode. So we're definitely still going to be heading toward this 200-week moving average, and that number right now is at 1.97. So 2% is the magic number. If we do get above 2%, then that's going to be a bit of an issue, but it does appear that level will be challenged over the next several weeks. So this is probably due to the inflation numbers that we're likely to see continue to come out over the next 4 to 6 weeks, as I do believe they're going to be running a little hot, and folks are going to be talking about the expansion in the economy, and the opening of the economy will also keep these rates moving much higher. The next market we'll cover is the S&P futures. They are down 950.23 overnight. They were down a bit worse, down about 6 more handles, about 14, 15 handles on the downside. We are seeing the PPMs, and this is what I was talking about in the opening comments. We're seeing them roll over, but they are in that trend maintenance phase, and I talk about this a lot, usually on the live stream. And what we're looking at is this pattern right here, where I talk about the momentum precedes price. So we see this surge of momentum, and these should come just as they are. They're stacked at different points during the trend, and they reconfirm the trend. And then what happens on each one of these is we get this, what I call trend maintenance mode, where it comes back in and they just go flat. This is all we want them to do. This is not about divergences or anything like a RSI or one of those indicators. So what we're seeing here is everything is in trend mode. So it's okay to a point they're not accelerating. I was hoping we would see some of these previous levels start to be challenged. We're not seeing that just yet. But these moving averages are going to continue to move in these upward slopes. These are weekly. And this is definitely going to keep things in a very robust mode. As we look at the market grid for the weekly, you'll see the ranges here. My expectation would be for a S1 4093, possibility of R2. Let's go to the daily charts and take a look at the market grid for that. It's actually very quiet overnight. We are seeing some decent volume, 73,000 overnight, but if we look at the market grid for today, we're going to see that S2 is 4105. That's already been reached, the low 4104.50, the high 4118. So we're coming up towards R1. My expectation will be see this S2, R1 be a minimum, but that will be your pivot point. Market penetrates through 4126 and look for an R2, R3 on the upside. One of the things that we did get, and we got it on the cash and the futures, we did receive an RTX sell signal. I've got the candlesticks up here, but the candlesticks just sticking slightly above. RXT was 4112. We actually closed at 4119. That when it closes above that, what it signals is 1 to 2 days of sideways. We could print up toward that, the numbers that I just mentioned, if we get above these resistance zones, but R1, S2 is probably going to be the range, so I do expect to see maybe a challenge to the upside. We'll ultimately see how the market closes tomorrow. We're going to the SPX now. This is where the RTX number is very evident. We did see the RTX on Friday was 4113. The close was 4128, so it's substantially above that number. We should see this thing come into about an R1, R2, which would put us around 4123 to 4118 as we look at the market grid for today. So there's not a lot of downside here. It's really just going to be some hesitation here, and all of these PPMs, when the cash market opens, will open up for will turn down in the morning. The weekly chart also got a RXT sell, which suggests that we could see a couple weeks of sideways movement, maybe moving back down below the 4,000 level. An S1, it would be possible this week, but most likely what we'll see here is an S1, R1 level would be min. On the upside, I still see us with a bias to the upside here. When you get an RXT sell signal, as I've talked about a lot, all you're going to get here is a sideways movement within the market grid. So we should not see a back-to-back RXT sell out of this thing or an STX sell. So the idea is that we would see S1, R2 would be basically the projected range for this week. The next market I'll cover is the NASDAQ. Very narrow range overnight. We have a 13,767 to 13,832. We look at the market grid for today. 13,746 is S2. We are just short of that. We could see a further downside. It's setting up for right now on a daily basis the potential for an R1 13,868 to a S2 on the downside 13,746. And if we do continue to see some weakness overnight, we may see this S2 print first and then a rebound up toward the R1. I do expect to see this market stay within the grid this week. I don't see it breaking out of that. So let's go to the weekly charts to see exactly what those numbers are. There's a fairly broad range. I mentioned this in Friday's video, is that I thought we'd see some upward expansion on the NASDAQ. We're now very much set for an R1 hit, will be an all-time new high in the NASDAQ futures. The old high is 13,890, so we'll definitely get above that level, minimum R1 with a S1 level, possibility of an S2. And realistically, if the volatility kicks up with all this news coming out this week, we could see a S2, R2, which would put us over the 14,000 handle for the first time. The final market that I'll cover tonight is gold. Gold continues to hover right around this 40-day moving average, 1742. Last trade is 1741.70. As I've been talking about, there is a substantial amount of resistance between 1750 and 1763. I still think we're going to stay somewhat in a sideways range this week. I think generally speaking, as I've been talking about, that gold is trying to set up a bottoming pattern. And I just want to draw in this pattern that I believe is unfolding here. The type of formation I'm expecting to set up is more or less a retracement here. I don't think we're going to go much below the 1700 level. You can see the S2 level on the grid today is 1702. 1711, 1702 should be the extreme. We get down to those levels. That will set up the point where we should start to see the market move up. I've been talking about seeing gold finally finishing a bottom over the next couple of weeks and starting to move up toward the 1800 handle and the possibility of moving back toward that 200-day moving average. Let's take a look at the weekly chart so we can see exactly the intermediate setup. And this same pattern is going to come into play. As I've mentioned, the 10-week moving average is substantial resistance. Right now it's moved down to 1745. The high overnight, exactly 1745. So we're going to see a lot of resistance here. As I mentioned, we should stay well above that 1700 level. Probably looking at the market grid here, 1724 down to an extreme of 1703. Anything down into this level will set up that right shoulder I just showed you on the daily charts, and this should complete the bottom. We look at the PPMs, you see PPM1 is turning up through its first and second derivative. This is a sign that we're going to ultimately take out and stay above the 10-period moving average. This is likely to happen this week, no later than next week, and then we will start to move up toward the 21-week moving average, 1801, and ultimately to the 40-week moving average, which is very similar to the 200-day moving average, which is going to put us up at that 1866 level over, and this is going to happen over multiple weeks, probably a minimum of 6 to 8 weeks, and once we get the confirmation of this pattern. This will complete the video for tonight. Thank you for watching. We'll talk to you tomorrow night. Hey folks, if you enjoyed this content, make sure you subscribe, hit that like button and the notification bell so you'll know when I do these videos.